Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Oliver Brown of RC Brown to talk about their AIM inheritance tax service. Hello Oliver, welcome back to the studio. So we're here to talk about your AIM IHT service. What is it? What does it aim to do for investors, and why should investors consider it?
Hi Jonathan, nice to be back in the studio. So our inheritance tax portfolio is a portfolio of 30 to 40 AIM stocks that, if held for a period of at least 2 years, will qualify for business property relief. And that means that if that individual, when they pass away, it will qualify for some inheritance tax relief. Now, our investment process is the primary opportunities investment process, which means that we like to buy a company typically at the stage that they are raising money. There's a number of reasons we do this, but the principal one is that if a company wants to raise money, it needs to open its books, which means that us and other investors can be as certain as they possibly can be that the company they're buying into is in the condition that they say it's going to be. And that reduces the potential for some nasty surprises further down the line.
And I guess that's the key differentiator to your AIM IHT service relative to others.
Absolutely. It gives our investors access to placings and IPOs that are typically the preserve of institutions.
So Oliver, taking a step back, for those who aren't familiar, who are RC Brown and what's your role there?
RC Brown was founded over 30 years ago, and we look after monies for a range of private clients, charities and pension funds. I head up the inheritance tax service and have been with the firm for 18 years. And prior to that, I qualified as a chartered accountant.
Very good. And so turning back to the service, aside from needing to qualify for business property relief, what do you look for in the companies that you back?
So we like companies that are market leaders or have a particular niche in their sector, because we believe that this helps protect their profit margins. We also like companies that grow, because ultimately we believe that stock markets, and particularly the AIM market, is about growth. So we want companies that have got a growth profile ahead of them.
And so Oliver, business property rules aside again, are there any companies or sectors that you exclude from the portfolio?
Well, we wouldn't invest in a company that is a business plan, something that is pre-revenue, because we simply would find that difficult to value, and ultimately those plans may not come to fruition. Example may be a company that is a biotechnology company that has got an early stage drug that is looking for regulatory approval. Now that company may become quite valuable if it gets a regulatory approval, but similarly if it doesn't, it may be close to worthless. And so that's just a very binary bet that we're not prepared to take. Also, mining and oil companies, very much sort of frontier, we're not going to invest in those either. They're simply too high risk for this kind of portfolio.
So avoiding some of the more, binary outcomes that you see on AIM.
Absolutely. We like companies that have got sales and profits, or at least if they haven't got profits, there's a pathway to profits that we can see and believe in.
And so do you have some examples of recent investments you've made in the service?
Yes, so we recently purchased a company called AOTI, which is Advanced Oxygen Therapy Inc., which is a healthcare business. It's a medical wound business, and it's very much focused on people with diabetes, which is obviously a growing problem in the world. And one of the issues people with diabetes have is they can get ulcers, foot ulcers. Now, if those are untreated or poorly treated, in the very worst circumstances, it can mean that they may have to have an amputation, which is clearly very bad for their own health and their mental health, and also costly for the service, the health service. And this company is very much focused on the US at the moment, and it came to the market in order to expand its presence in the US. And in time, we expect it to grow into Europe and the Middle East. It's a company that is profitable, it's growing well, and really now for us, it's about execution, and we think it's an exciting business.
Any other examples?
Yes, a company called Kitwave, which is a wholesale business, that delivers goods. So think of fresh goods and frozen goods to local convenience stores, to local pubs, local restaurants. So those kind of businesses that need regular deliveries. Now, we have actually held this share in the portfolio since its IPO back in 2021. It's performed very well, but recently it raised some more money. So we added to our portfolio holdings because it wanted to acquire a business, a complementary business. And it's been very, very good at buying companies, competitors, smaller competitors, improving their performance. And it's a very fragmented market. And it's a company that we think is modestly valued, and there is further value ahead.
Very interesting. And so turning perhaps to some of the more established holdings that have been in the portfolio for a while, do you have any examples there? Any highlights?
Yes, Elixirr, which is a consulting business that we bought at IPO again back in 2020. It's very much a challenger to the many established brands, so the Deloitte Consultings, PwCs, and it's a company that has consistently outperformed and raised expectations. It's got a very, very good management team, and recently acquired a business in the US to expand its presence there. And the US is the biggest market in the world for consulting, so we think it's a good quality business.
Any other examples?
So Gamma Communications,
Okay.
which is one of the largest companies on the AIM market, and it's been very successful at growing its UK business. It's very much focused on sort of the small and medium-sized enterprises that are often rather neglected by the large telecom incumbents. But again, it's used the stock market well to acquire businesses in Europe and has expanded very well and very consistently. And we believe there is still further growth to come into the market as you see the switch off from analog to digital.
So we've spoken a little about how you like to buy stocks, typically favouring a placing or an IPO. But what about when it comes to selling a stock? How do you go about selling a stock, and when do you decide is the right time to sell a stock?
Yes, so we would look to sell a stock or reduce our holding if there's a primary opportunity that we want to participate in. And where we see good growth prospects. Also, if a company comes out with an unexpected, disappointing trading update, and we think there is further downside in the shares, then we will look to exit. And also, if we've lost sort of faith in the management and the direction of the company, then we would also look to exit there.
And Oliver, turning to the AIM market, it's clearly been a very challenging couple of years for AIM investors. How has that environment affected your portfolio and your service? And has it affected sort of new opportunities coming to market?
The AIM market, you're right, has had a difficult period. And as we sit here today, the AIM market is down a small amount this year. But I'm pleased to say our own portfolios have returned around about 8% year to date as we sit here today. And the market has raised about 1.5 billion has been raised on the AIM market this year, which is lower than some previous years. But moving into 2025, there are quite a number of companies that we're aware of that are looking to raise money and potentially IPO if market conditions are right. And we think this is actually a really exciting time to be looking at the AIM market and investments there.
And that leads perfectly on to my next question, Oliver, which is, are there still good opportunities to be had on AIM, and where are you finding them, if so?
Yes, absolutely. There are around about 700 companies listed on the AIM market currently, and that is down considerably from the 1,700 or so that were listed in 2007. But in our view, the AIM market has never had higher quality businesses on it. It's not difficult to build a portfolio of really good quality companies that are growing, that have got global growth profiles as well.
And Oliver, how risky is the AIM market, and how do you describe the risks to your investors?
So it should certainly be considered to be a higher risk portfolio because you are investing in smaller companies, often younger companies, and things can and do go wrong. Also, at times of economic distress, smaller companies do tend to underperform because there tends to be a flight to more larger, more liquid names. Having said that, on the flip side, for an investor that has got a long-term time horizon, is able to deal with the inevitable bouts of volatility, we do believe it is very possible to build a portfolio of good quality companies on the AIM market that is well diversified.
Oh, good. And so finally, Oliver, to sum up, for those that are looking to invest in an AIM inheritance tax service this year, why should they consider RC Brown?
Well, our primary opportunities approach is genuinely unique, and it gives investors the opportunity to participate in placings and IPOs. They're very much the preserve of institutional investors. Our annual management charge is very competitive, and we don't charge when we buy and sell stocks. So we're able to be very active without adding cost to the client's portfolios. Also, we have been investing on the AIM market since its inception nearly 30 years ago. So we're very experienced, and we understand the benefits and the potential of the AIM market, but also some of the pitfalls as well.
Very good. Oliver Brown of RC Brown, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.